Hey everybody, welcome back to the channel. I hope you're doing very well. Have you ever noticed how much misinformation there is online about mortgages? So I thought it might be very valuable for everybody online to get some actual mortgage facts instead of mortgage myths. And to pull out some of my credentials here, I personally have done over 3,000 pre-approvals, have reviewed over 3,000 credit reports, and closed 400 to 500 loans in my career, totaling almost $300 million in volume. So I've seen a thing or two. Let me know if you think I'm crazy or why you think I'm wrong. I do respond to every single comment. And without further ado, let's get into it. Today we're going to start the series off with a great creator named Andre G. He made a video last week called The Coming Real Estate Meltdown.
The Federal Reserve Bank of Atlanta found that a median income household would need to spend 34.9% of its yearly income on a median priced home. For reference, households that pay more than 30% of their monthly income for housing are considered cost burden.
So I did want to share that in my experience, for a median priced house, this is extremely common. I would estimate over half of the borrowers I've helped pre-approve and actually buy homes in the last 5 or 6 years, that they are using between 30 and 40% of their household income towards that housing expense. Now keep in mind, an important caveat on this is what the mortgage lender is allowed to use as qualified income. So oftentimes if someone gets an annual bonus, or if someone works overtime, or if someone consistently works part-time, but they changed the company they work part-time for on the side. And in general, mortgage lenders can't use that income. So when they compile all this data from millions of different loans, it usually looks a lot worse than it actually is. The debt-to-income ratios that I am forced to use to qualify borrowers is more strict than you would assume. So in my opinion, it is true. It is not ideal that people are paying a third of their gross income towards their housing expense, but I don't know what the solution actually is, because at the current price levels, you have 80% of the population locked in with fixed rate debt at or below 4%. There is not going to be a forced seller scenario. And for those of you who are renting and don't know or are not unaware of this, during the pandemic, the government allowed people to claim loan forbearance, and there was very little evidence needed of hardship. So there were people who went a year or two without paying on their mortgage at all. And at the end, the government basically forced the lender to give a loan modification to those borrowers. So if they missed $30,000 worth of payments, then it would just simply added to their loan amount at the end. And maybe their payment was adjusted or maybe it wasn't. And it is my strong belief that since that Pandora's box has been opened, no one can close it. Unlike 2008, where there was millions of people kicked out of their houses and put on the street, and there was massive economic turmoil, no politician is going to vote to do that again. So I think there's a very high likelihood that anyone who gets into a home or is already in a home, if there is another bad economic situation, they will simply do what the government does best, which is extend and pretend, and they will allow people to claim forbearance on their loans to keep people in the house. Let's continue.
According to the Department of Housing and Urban Development.
And people are burdened because inflation is still outpacing people's wage growth. And you could argue that it's more than just an issue of supply and demand, it's also a problem of affordability.
Okay, I do want to react to this part. So yes, generally wages are always going to be slower than inflation, especially with the modern government that we have and the people who are in charge, and the people a lot of the population continues to elect. They do not want a balanced budget and they want to spend more. Inflation comes from when the government spends more money than it has, and it has to borrow money and conjures money out of the ether from the Federal Reserve and the US Treasury into existence, and that devalues the currency, which is inflation. In my opinion, that is what makes an American 30-year fixed rate loan a cheat code to wealth. Because if you stay in that home long term, no one's going to be able to kick you out as long as you make your payments on time. And as I just mentioned, with forbearance being a thing now, they still might not even kick you out. And so in a free market, nobody would lend money to anybody for 30 years at a fixed rate of interest. That's why in most of the other developed countries, Australia, the European Union, UK, and Canada, they have adjustable rate loans. When you talk to someone from those countries, they'll say, yes, I have a fixed rate loan. But what it means is that their interest rate is fixed for generally 2 to 5 years, and then it adjusts. So it's exactly the equivalent of an American adjustable rate mortgage, where it does adjust every set period of time. but it is amortized over 20 to 30 years. So you have a significant portion of the Western European population, Canada and Australia and New Zealand, coming up on mortgage debt that is going to switch over to the much higher interest rates. And you're going to have 100 million to 300 million people with mortgages that their payment increases 20, 30, 40%, and they can't afford it. Whereas in America, 30-year fixed rate loan, your interest rate stays the same for 30 years. If you literally just stay in your house and stay there long term, inflation will outpace your mortgage. You are getting a great deal over time. Because in the meantime, if you only put 3 to 5% down when you buy a house, you could be investing all of that other money, which is going to have a way higher ROI and help you beat inflation. And not only that, inflation causes house prices to go up. So if you buy a house with a low down payment, leveraging the mortgage company's money to make money via inflation. Inflation will make you rich if you know what you're doing. If you buy a property, do not anticipate on moving for a very long time. That's extremely important.
Just take a look at the data on down payments.
The Center for Responsible Lending calculated that a typical worker needs 8 years to save for a 3% down payment for a medium-priced home and 30 years for 20%.
Okay, we're going to rewind here. This chart right here, I would say 50% of the discussions online about buying a house is because of things like this, and people are not educated enough on what mortgage options exist. There are a significant portion of people in the demographics on this page who believe you need to put 20% down to buy a house. And if you put any less than that, you are not qualified and you will not get a loan. What those people are missing out on is if, let's say 8 years ago, they would have actually bought that house, their property would be double the price and their mortgage payment would be significantly lower than market rent, as long as they stayed there. The other thing I wanted to tell you is that I am licensed in Texas, but I do know for a fact that many states have down payment assistance programs. If you go online to Redfin or Zillow, there's a down payment assistance section, and clearly you don't want to just rely on the information there. You do want to speak with a mortgage professional like myself to learn about all of your options in your local area. But for example, in Texas, there are many jurisdictions where you can put no money down, where you can get a forgivable second loan or even a grant from the local city, county, or state. So for example, I have helped people buy a $250,000, $300,000 home, and they put no money out of pocket to buy the house. And as long as they stay in that house for 3 years, there's no payment required on that second loan and there's no interest on it. So after 3 years, that second loan simply disappears. Thank you, state of Texas. You can structure these sorts of things to have the seller help pay with closing costs. So even if there is a down payment assistance and you still might need to bring in $2,000 or $3,000 to cover the leftover closing costs, you still can negotiate with the seller to pay that from their proceeds. So at closing, you do actually bring nothing to the table. There's so much misinformation online. It has caused so many people to not pull the trigger and buy a house that they're so far behind. So for example, if you were to buy a home with down payment assistance with 3% down on a conventional loan, after a while, your mortgage insurance is going to fall off automatically. That second lien is going to fall off automatically. You're set. And then in the future, if interest rates go lower, you can always refinance your loan. Otherwise, you just set it and forget it and live your life. I hope you learned something. If you stayed to the end, make sure to absolutely subscribe to the channel, like, comment, tell me about your opinions on this. Tell me why you think I'm wrong. If you think I'm wrong, I will absolutely respond to every comment down below, and I'll see you on the next video. Have a great day.